Hello and welcome. You're watching live session on the economic outlook for India, powered by Investonomics, an initiative by ICICI Securities. India is one of the few economies that is currently in better shape than its global peers and may stay resilient in 2023 too. These are the key takeaways that we are hearing from World Economic Forum meet. Analysts are optimistic about India, claiming that even if the major economies head to recession, the impact on the country will be modest due to its strong macroeconomic fundamentals and its internal demand. Having said that, India's critical manufacturing sector could benefit from moderation in commodity prices, but will surely feel the pain of lower external demand if recession sets in. To talk about how well placed India is among major economies, joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Very good evening, Mr. Basu, and welcome to the show.
Good evening, Gitu.
Mr. Basu, what we are hearing from the World Economic Forum is that global economies, the major ones, might slip into recession later this year. And according to the latest report, average real GDP growth rate for G20 emerging market economies in 2023 is expected to decline to 3.1%, the lowest in more than a decade. What, according to you, are the key risks to economic growth, and where does India stand?
Well, yes, of course, the major risk to the world is the prospect of a recession. There's been a monetary policy error by the major central banks, especially the US Fed, and actually even more than the Fed, the European Central Bank was very slow to clamp down on inflation. Remember, the ECB's target is 2% headline inflation, and the ECB is consequently very, very far away from that at the moment. If it is to get to 2% headline inflation, then the ECB will have to tighten policy quite a bit substantially further. At a time when already there are some signs of deflationary factors or disinflation month on month in Europe, but the headline year-on-year inflation rates are extremely high, and they need to respond to that. So similarly, the Fed has, of course, done a lot last year. They raised interest rates by 425 basis points. That's the biggest hike in a single year since the mid-1980s. So a very significant tightening of policy has in fact occurred. But the impact of that will play through this year and will cause the economy to go into recession. If you look at the 10-year minus 2-year yield curve in the US, it has been inverted since the 5th of July last year. So we've had more than 6 months of inversion, and it's very steeply inverted. I mean, it was, the difference between 10-year and 2-year yields was as much as 82 basis points, minus 0.82%. About a month ago, it's still about minus 0.73%. So very, very deeply inverted yield curve, indicating very clearly that a recession is imminent. And in fact, if you look at other things, if you look at the ISM manufacturing new orders, they're a very good 6-month leading indicator. And they had turned, they've fallen below 50, the mark that separates expansion from contraction. They fell below 50 over the last 3 months. So that too is indicating that by the second quarter of this year, the US will be in recession. Now, the ISM manufacturing new orders are in fact also a very good leading indicator of US demand for imports from Asia or Asia's exports. Right. And interestingly, Asia's exports to the US have slumped already in November and December. So if you look at India's exports to the US, they did a little bit better in November, but December has been pretty bad for India's exports too. Sure. So already we are seeing evidence that the US demand factor is abating very quickly, and that is going to be an important risk factor for the world as we go forward. We have a difficult year ahead from an economic standpoint.
So, Mr. Basu, so what should be expected from the Fed this time? Because There has been a cool off in inflation, if we talk about the US, and it is also being talked about that the hikes would not be as aggressive as they were in 2022. So, do you expect a modest rate hike and then a pause for some time so that the economy doesn't get into deep recession?
Well, I do expect that hikes will be much more modest, perhaps just 25 basis points each over the next couple of meetings. And
Mhm.
I expect that the Fed funds rate will peak at 5% in March. So after March, there'll be a long pause. I expect a pause of about 6 months
Mhm.
because inflation will finally be coming down, and it should be below that 5% mark so that we'll have a
Mhm.
positive real rate by the second quarter of this year.
Mhm.
But headline inflation and core PCE inflation, core CPI inflation, will still be too high. So the Fed cannot cut rates. It can just pause until there is evidence that inflation has actually moderated. And once inflation gets down to about the 2.5% mark, which I expect by about July, August,
Mhm.
then the Fed can actually start cutting rates
Mhm.
by perhaps the September meeting.
Mhm.
So that's the US view. With regard to India, I think the rate hikes are done. I think
Okay.
the last of the rate hikes in India was the one in December. The policy repo rate now is 6.25%, and that is, I think, sufficient given the fact
Mhm. Mhm.
that we've now had 2 consecutive months of inflation below 6%.
Mhm.
So the current real policy rate in India is plus 0.33%, and that's sufficient to keep cooling the economy down.
Mhm.
Over the next few months, base effects will be helpful for inflation. Remember that CPI inflation in India was above 6% for the whole of the period from January to October last year. And relative to that higher base, uh, this year's inflation numbers are going to be looking a lot more tolerable. Uh,
Mhm.
in the first quarter, probably closer to 5%.
Mhm.
In the second quarter of the calendar year, inflation should be easing to below 5%. When that
Okay.
happens, the RBI will be under no real pressure to tighten policy much more.
Mhm.
Instead, they can look forward to the possibility of cutting rates. And I think
Mhm.
that'll come
Mhm.
uh, perhaps in July, August.
Mhm. Mhm. So, are you concerned about the widening trade deficit that we have been witnessing lately? And as you just mentioned, that exports in the month of December have seen a sharp fall. So, with this kind of a trade deficit that we're talking about, and then we are talking about recession happening in the developed economies, how do you expect the government finances to be, and what is expected from the budget 2023 this time?
Well, there's two sets of questions. First of all, the trade deficit.
Yeah.
Now, the trade deficit actually was worse in the July to September quarter than in the October to December quarter. There was actually an improvement.
Mhm.
But exports, and the improvement was partly because import growth slowed down.
Mhm.
Now, we've had 2 months of contracting exports, year on year contraction in exports
Mhm.
in October and December.
Mhm.
Now, the important reason for that is that there were export duties in place.
Mhm.
Export duties on iron and steel products continued to be in place until the 22nd of November last year,
Mhm.
and export duties on petroleum products are still in place. Now, petroleum products account for about 24% of India's exports. Steel and steel products account for about 10% of India's exports. So, more than a third of India's exports were being constrained by the imposition of export duties, the
Mhm.
main purpose of which was to bring domestic prices down for
Right.
petroleum products and for steel. And that has largely succeeded. Externally, uh, we've seen the Brent crude price come down sharply, um, and uh, and refining margins too have moderated a bit. So So in fact, that is helping on the trade balance a little bit. It's also helping on the inflation front. Now, with the removal of export duties on steel towards the end of November, we should begin to see some improvement in the export numbers. And hopefully soon, within the next 3 to 5 weeks, we'll see the removal of the export duties on petroleum products as well. And once that is done, then exports can do a lot better going forward.
But that will be the case only if the developed markets demand stays intact, right?
Yeah. So the developed markets are going to see their demand is going to be very sluggish, and so India's exports can only continue to grow strongly if India gains some competitiveness. Now, if you look at the rupee, I said at the last two meetings, in fact, the last two such presentations, Investonomics, that the rupee is going to continue to stay relatively stable against the US dollar.
Yes.
And the dollar itself is going to weaken. And since the dollar is weakening, the rupee will weaken against several currencies against which it had appreciated earlier in the year. So from March to October, there's substantial appreciation of the rupee against the euro, the pound sterling, the British currency, the Japanese yen, the Korean won, and the Chinese renminbi. Against these five important currencies of trading partners and competitors, the rupee had appreciated between March and October. Since the middle of November, the Indian rupee has given up all of those gains against the euro, the sterling, and the Chinese renminbi. In fact, now it is year on year slightly weaker, but it is still slightly strong against the won and yen. So what that is telling us is basically that, even with the won and yen, a lot of the competitiveness lost earlier in the year has been regained. Not all of it, but a lot of it. Against the other currencies, there has been a gain in competitiveness. So that is going to help export performance somewhat as we go forward. Also, it's important to understand that India also trades a lot with the rest of Asia, where demand hasn't fallen off a cliff. And the third largest export market for India is the UAE, with which there is a free trade pact.
Right.
So all of that should ensure that we'll get moderately positive export growth going forward, and a trade and current account deficit that remains well contained. So I'm looking at a current account deficit of 2.5% of GDP in the current fiscal year, the one that's ending in March this year, and continued strength next year as well.
So as we gear up for the last budget before the election of 2024, do you expect the FM to remain on the path of fiscal consolidation, which is everybody is expecting that to be, but this being the last full budget before the general elections, we can expect some bit of populism in this budget too.
Well, I think this government doesn't indulge in too much populism. If it had to, then the time to provide a really big fiscal stimulus was during the COVID period. India distinguished itself by providing much less of a fiscal stimulus, running a much smaller deficit than most countries in the world. So the US and Europe were running fiscal deficits of over 15% of GDP at one point. India has never really got anywhere near those levels. So India has been fiscally prudent, and I don't expect them to drop the fiscal prudence just 15 months before the next election, next general election. So I don't think there'll be significant fiscal stimulus. They're not going to be, basically they're going to continue the path of fiscal consolidation, which means that the fiscal deficit will steadily be coming down on a slow glide path. But I think it's worth understanding about the fiscal position that corporate and income tax revenues are very strong so far this year. They don't indicate any sort of impact of any recession. So, that will help. The fact that you've got very strong corporate and income tax revenue. So if you look at corporate income tax revenue, they're up nearly 27, 28% year on year in the fiscal year to date. GST revenue is up more than 20% in the fiscal year to date, which basically means that the fiscal deficit for the current fiscal year is going to stay quite well contained. The actual number will be well below 6% of GDP, although they may not recognize it.
Okay.
They see, now the thing is that the budget now is presented 2 months before the end of the fiscal year. The best month for the fiscal balance is March. The last month of the fiscal year is the strongest one for revenue, is the strongest one for exports. So that quarter is where a lot of the actual revenue comes through and the fiscal deficit comes down. And particularly it's the final month of that quarter. So if you look at fiscal deficits in the April to November period, in 2008 and 2018 and 2019, the last 2 years before the COVID struck, the full year fiscal deficit had already been exceeded by November. It was 102, 103% of the full year deficit by that point. This year, in April to November, the running fiscal deficit is only 46% of the total for the full fiscal year, which basically means that India is reducing its market borrowing. The government, the central government in particular, but also state governments are reducing their net market borrowing. And that is helping to crowd in private investment. And that, I think, is what is going to keep the Indian economy growing quite strongly as we go forward. So will there be SOPs in the budget? I don't expect significant SOPs. I do think that the rural economy does need some support. And consequently, we're going to see some support in the form of fiscal transfers, perhaps cropping subsidies, seed subsidies, some such measure to help the agriculture sector, which has suffered quite a bit in the past year and a half after doing remarkably well during the COVID period itself.
So how do you expect the commodity market to behave in 2023, despite of the fact that 2022 was equally good? I mean, there was around 22 to 23% of returns that these commodities, basically metals and crude, gave during that year. So what is the outlook for 2023 with focus on metals and crude?
Yeah, well, I think commodity prices are dependent to a great extent on Chinese demand. And I think there's a great deal of uncertainty about Chinese demand this year. On the one hand, there are people in the market who are predicting that China will be going back to normalcy, which would mean that a huge pickup in energy demand and commodities demand. But my view on China is the following. First of all, in the near term, China is in the midst of a very serious COVID wave. COVID is raging through China at a faster pace than at any time in the last 3 years. And China has now acknowledged that they had about 60,000 additional deaths beyond the number they had previously put out. If you look at the long period before, there were only about 5,600 deaths in the first 3 years of COVID. according to the official numbers from China. Now they've admitted that in the past month, they've had 60,000 COVID deaths. Now, over the next 2 weeks, there'll be a mass migration of workers from urban areas moving to rural areas. And that mass movement is essentially uncontrolled. And it's likely to take a big wave of COVID into rural China, where health facilities are relatively poor, the number of doctors is quite limited, etc. So then this 250 to 300 million people block will move back to urban areas. So you could have first, second, third consecutive wave of COVID. So the near-term outlook is quite difficult, given this backdrop. I think that beyond that, we'll see moderate improvement in commodity prices, but that really now is increasingly dependent on India allowing in sufficient imports to keep that going.
So where do you expect the crude to settle in 2023?
So yeah, you see now with regard to crude, near term, I think that crude will stay in the sort of $70 to $90 barrel range. Other commodity prices, I don't think are going to go off to the races. I mean, people are, we've had a pretty good fortnight for commodity prices in general, in the expectation that Chinese demand is going to take off. Yes. I don't think Chinese demand is going to take off in any significant way. What will happen is a moderate improvement in Chinese demand. There'll be some support from India. India's recovery in investment spending will provide a little bit of support. But I don't think India, given the size, given that the Indian economy is only about a fifth the size of the Chinese economy, India cannot really replace Chinese demand. But what will happen is that post this COVID period, this quarter, I think is a tough quarter for China. But hopefully you'll have, perhaps, a large number of people contracting COVID this quarter. Many, perhaps even 1 million or 2 million people could die in China. But once that's done, China would have acquired a degree of immunity, and then the Chinese economy could normalize in the second quarter and beyond. So when the Chinese economy normalizes, China's import demand is expected to take off and really strengthen. Some people believe. Now, I don't think it's going to take off in that way. Because China, you see, basic problem in China is that the final buyer of property, the population has lost confidence in the property market. They have just seen the first significant downturn in property prices in their lifetimes, and there is great nervousness about property purchases. So China is trying to help the top 10 property developers, trying to prop them up by providing them a $256 billion line of credit. So there are rescue operations underway, but the rescue operations aimed at preventing a collapse of property developers. Too much support to actual buyers of property. The buyers of property have lost confidence, and so I think the entire edifice of the Chinese economy is built around property and overall investment spending. And that is going to stay relatively subdued. And if it is subdued, you can't see commodity prices doing too much. So to answer your question, I think Brent in the near term will stay in the $70 to $90 barrel range. Thereafter, I expect that Brent prices will be moderating rather than going up. Of course, Goldman Sachs is claiming that Brent will go to $100 a barrel quite soon.
Right.
3 or 4 months ago, they were saying $300 a barrel, remember?
Right.
So, their credibility is a little bit short at the moment. But yes, there are some concerns about supply. There are concerns about supply from Iran and the shale gas situation in the US. Normally after a long period of high oil prices, we should have seen a new burst of investment in shale exploration and production in the US, and that hasn't come through. So yes, there are some supply constraints in oil, but I don't see demand really picking up anywhere in the world in the near term. So I'd say that this year is going to be a relatively calm year for oil. It'll actually be a relatively calm year for commodities in general as well.
So we have been very optimistic about pickup in private capex, but as you spoke about, China crisis to last for another quarter. Then you have Europe and US market entering into recession. If that is the case, do you really expect that private capex cycle to take off in India anytime soon?
Well, private capex, I think, is already taking off in the sense that if you look at, the key thing that is driving that is the fact that the fiscal deficit in India, as I pointed out just now, its fiscal deficit is proving to be lower than the government had predicted at the budget time last year. So the fiscal deficit is lower, partly because government revenue is soaring. Tax revenue, direct taxes are very strong. GST is very strong. So those, corporate and personal income taxes up more than 28% year to date, year on year. GST revenues up more than 20% year on year in the year to date. So that is ensuring that the fiscal deficit is coming down. It is proving to be a lot lower than the government had projected. And so the market borrowing by the government is down. When the market borrowing is down, that helps to crowd in private investment. Now, evidence that private investment is already being crowded in comes from the strength of capital goods output and capital goods imports. Capital goods output in the year to date, April to November, is up 14.9% year on year. And in the month of November, the latest month, capital goods output was up 20.9% year on year. So if anything, it is strengthening. Now, in addition, capital goods imports in the year to date, April to November, are up nearly 25% in dollar terms. So we're seeing both recovery in investment spending that we have been waiting for nearly a decade now. For a decade, there's been almost stagnation in capital goods output, for instance. Now there's a really powerful rebound in capital goods output, at least in the first 8 months of the fiscal year, and that is, I think, a hopeful sign. Now, my reasoning behind this, in addition to the crowding in of private investment because the government's market borrowing is down, that is one. That's the domestic factor at work. But the international factor is one that I've been pointing to for several months, which is that China was over-investing for the last 25 years. It was investing at a spectacular pace, and that over-investment by China led to an investment drought in the rest of the world, including in India. India's investment drought was actually a lot better. It wasn't as bad an investment drought as in the rest of the world, in Europe, in Korea, in Japan, Thailand. These countries, investment was very, very depressed for a long time. In the US, Singapore, the likes of Taiwan, Indonesia, fairly large economy like Indonesia, there was 3% compound annual growth in fixed asset investment over the last 25 years. So it's all depressed. Now, and my logic is it was depressed because China's investment spending had increased 18-fold in those 25 years. So China had overinvested, causing the rest of the world to underinvest. There was an investment drought. Now, China, I think, has come to the end of the road with regard to its investment boom. It has to deal with its overcapacity issues in industry and real estate. And the downturn of the last year, the overall downturn in the property market demand particularly, but in the overall economy as well as now the COVID-related issues, all of that is making it very difficult for China to start thinking about a new investment boom. China cannot really go for an investment boom. So it is constrained. And since China is constrained, there is an opportunity for the rest of the world to invest. And the way I look at it is that, India is the second biggest producer of steel, aluminium, cement in the world. It's the fourth or fifth largest producer of cars. And all of these areas are where the private investment boom is likely to occur. So if you look at, the major corporate groups in India, the Tatas have about $270 billion of investment plans in the pipeline over multiplicity of sectors. The Reliance Group has substantial plans. They've announced during the last earnings season a very substantial number of investment plans in 3 or 4 different areas. The Adani Group is also looking at substantial investments. ArcelorMittal, in partnership with Nippon Steel, is looking at a $24 million ton steel plant in Odisha. So you're beginning to see very substantial investment plans being announced. We're seeing evidence of some actual investment in the capital goods output and import numbers. So I think that despite the global downturn, India is finally seeing an investment recovery because China is not investing to anything like the same extent. Now, I've just been to meet investors, clients, investment managers, fund managers in Singapore over the last 3 or 4 days. And what is quite striking is that those who talk to corporates in China say that nobody is talking about investing. It is very unusual in China to have a situation where nobody is looking to invest. Certainly, the property sector is looking moribund in China. So I think the evidence at the moment is that China is living up to what I expect them to do this year, which is not to go on an investment spree, which creates an opportunity for the rest of the world. So in India, the production-linked incentive scheme is an extra factor that will stimulate this investment recovery. In the US, there's something called the so-called Inflation Reduction Act, which actually is an investment stimulation act, especially in some high-tech areas like semiconductors and solar panels, etc. So the US is trying to stimulate an investment recovery. India is already seeing an investment recovery. And all that is really possible if China stays on the sidelines. And I think China is largely staying on the sidelines from everything I've heard from those who know the Chinese corporates well.
I raised this question because I happened to speak to one of the bankers who I spoke about the corporate books as far as the loans are concerned. So they said, The credit growth is picking up, but then it is not from the corporate side. It is more of refinancing and restructuring than for the new brownfield or greenfield investment that corporates are borrowing. So that is why I wanted to have a clarification on, is really there's a pickup of private CAPEX cycle happening in India or not, which we are too much relying on after so many years of a lull in the market. So there was a report from Ernst and Young, I guess, where it says that Indian economy would be $26 trillion by 2047. Is there a possibility of becoming $26 economy? Then what should really be done in India to reach this magical figure?
Well, you see, I mean, 25-year projections are fraught with risk and uncertainty. You can put any figure out there, and it could be hopelessly wrong, or it could turn out to be right, or to be in the right general direction. A lot can happen in 25 years. So if you were in the year 1900 and you were in Buenos Aires, Argentina, you would be living in one of the richest cities in the world. By 1950, that city would be a den of trouble, economic trouble. Numerous sovereign defaults would have occurred in the intervening period. So it's difficult to predict things for the long term. Wars can occur, nuclear disasters can occur. So many things can happen over a 25-year period. Right. So I am an optimist about India in the medium term, in the long term. There's no doubt that we are generally moving in the right direction. If things are normal, if you don't have too many major conflicts and disasters, if climate change doesn't affect us too badly, all of these things are in place, then yes, in 2047, we could well be a fairly developed, or at least middle income or high middle income economy. So that is certainly the case. But I think the one very important missing element of India's emerging economic success story is the labor-intensive manufacturing and labor-intensive exports. So a striking and worrying aspect of India's export performance over the past 10 years is almost complete stagnation in exports of textiles, garments, gems, and jewelry. Now, those are three extremely labor-intensive segments. And gems and jewelry, we're already among the world's leading players, and perhaps there isn't that much scope to grow. But if you look at textiles, garments, shoes, toys, processed food, those are the labor-intensive components that India should be producing in massive amounts. As I've said, I think a few times on these talks, every industrializing country has begun with successful and massive scale manufacturing of labor-intensive products, and typically they are produced for the world market. So if you think about clothes, shoes, toys, these are things that are required. Children are always going to be born. Babies will need toys. So until they are about between the ages of 0 and 15, toys will be required. We produce very few toys compared to the world market size. Almost nothing, less than 1%. Our share of textiles and garments in the world market is very small. Our exports of textiles and garments are just over 1/8 of China's, less than 1/9. Now, so what is required is, if out of that 8 times larger textile and garment exports that China has, if we aim to take 1/8 of China's share every 4 years, that provides us a doubling. In 4 years, we'll double our exports of textiles and garments. And we do that for, now, easier said than done. Basically, there is obviously there's something that is standing in the way of labor-intensive manufacturing and success with that. To my mind, a key reason is that we had traditionally a labor market that provided a disincentive to hire people because it was so difficult to fire them. Now there are, for the last, not just this government, but even the previous government was trying to find ways around it. In the past, industrial policy that was announced around the year 2010 or 11, previous government said, we'll create special economic zones where you don't have to comply with the labor laws. So, the labor laws will effectively not be implemented properly, etc. That didn't work. Then you had the Make in India initiative of Prime Minister Narendra Modi at the beginning of his term. The idea being that labor-intensive manufacturing would be a big part of the story as well. That didn't really work. So now we've got the production-linked incentive scheme aiming to do that. In addition, this government has passed labor market reforms, which are very positive. They were passed 2 years ago. They were signed by the president, so they are almost the law of the land. But you need to gazette and notify those laws. That hasn't happened yet. I'm waiting for them to be gazetted and notified and then implemented. So once that is the case, and once investors, manufacturers recognize that it is a little bit easier to close down a factory and lay people off at the end, or have contract labor, particularly have fixed-term contracts for workers, then once they recognize that India actually is a much more flexible labor market than it used to be, then you start seeing really large-scale labor-intensive manufacturing happen. This is an essential feature. There is no way of escaping this. You need to do labor-intensive manufacturing if you are to become a moderately prosperous country with no absolute poverty. Absolute poverty in India has been largely eliminated, but what is required is for people to have decent jobs so if you employ, say, 250 million people in industry, labor-intensive industry in particular, then that creates sufficient jobs for pretty much all households to live at a very civilized and decent level. In its absence, we'll have second-best solutions, but really labor-intensive manufacturing is essential. So, if you look at Arvind Panagariya, the former vice chairman of Niti Aayog, he has been beating on this drum right through as well. Every 2-3 months, he'll write an article saying the same thing. And frankly, more power to him. We need to listen and we need to get this done because this is really quite essential. And frankly, if we get labor-intensive manufacturing going on a large scale, then we will start seeing 10% GDP growth annually. Currently, with the current approach, we're in the 7 to 8% GDP growth range. To get that additional 2 or 3 percentage points a year, we need labor-intensive manufacturing to take off, and it's not doing it yet. And by labor-intensive manufacturing, I don't mean Foxconn, Westron, and Pegatron assembling iPhones, or even adding a whole ecosystem of of the supply chain for iPhones. Okay, that is wonderful, and that is going to employ quite a large number of people, and those will be fairly large scale plants. But it's not it's skill intensive manufacturing. India is already doing a lot of skill intensive manufacturing. If you think about cars, that's a form of skill intensive manufacturing. Steel, other engineering goods. Skill intensive manufacturing is something that India is quite happy to do. Indian corporates, multinationals investing in India, all participate in skilled labor intensive manufacturing. But manual, unskilled labor is, well, it's not entirely unskilled. If you're working on a textile assembly line, it's not. There's a little bit of skill involved, but that sort of thing, where you can have mass employment, really needs to take off. So the day I hear that 100,000 person factory has opened in, say, Kanpur to manufacture clothes for Gap or Walmart, or even for the Indian retailers. Once I hear of one such plant, I'll begin to get much more optimistic about India's prospect. And it could be Kanpur, could even be Kolkata. Why not? If Dhaka has so many of them, why not Kolkata or Patna? So, or Guwahati, or it could be anywhere. Now the point is that if we get, I must say, just today I saw in the newspapers that West Bengal is putting out 3 or 4 very small, a few 26 acres here. And anyways, they're putting out some land for textile and garment manufacturing. I said, okay, this is, at least they are thinking about the right thing.
Right.
So now, if we see more of this, then and people actually respond. It's one thing for state governments to hope for it and to put out the welcome mat, but in addition, if manufacturers respond and put the plants up, then the whole prospect of India in the medium term will be transformed.
So what is your outlook for the currency? Let's say rupee, as you already stated, that it has been strengthening against dollar. Some kind of a strength is back.
Stable.
But
it's stable against the dollar. It has weakened against the euro, pound, won, yen, renminbi. Against all of which, those 5 currencies, the rupee had been appreciating in the previous 8 or 9 months.
Yes.
It has, since November, it has lost against those. It has depreciated, and it's been fairly stable against the dollar. So I think that this will continue for a while until we have evidence of an export revival. So exports should do a little bit better, given that the export duties on steel, iron and steel products have been largely removed, and hopefully we'll see removal of export duties on petroleum products quite soon. Once that happens, then you can see then the rupee can start appreciating a bit against the dollar, because the dollar is depreciating against most currencies, simply because the dollar has had a tremendous run for 2 or 3 years.
Yes.
And now that we are getting to the end of the US tightening cycle, the dollar has no additional reason to keep going up. Now we're looking at other countries easing more. Other countries like Europe tightening more. So you'll see Europe tightening, you'll probably see, Japan, which
Yeah.
hadn't done anything with with monetary policy tightening in about 10 years, suddenly announced that the yield curve control target had been raised uh, to 50 basis points. So that, the fact that that Japan began to move in the direction of even a mild tightening, the fact that Europe has quite a lot of tightening to come, the fact that the Bank of England probably has quite a lot of tightening to come, all of that is contributing to the relative strength of those currencies against the dollar. Yeah, so now with regard to the India situation, declining oil prices, of course, are great for the external balances. And as long as the oil prices continue to edge lower, as I expect that they will do, the trade and current account balances will improve. And once you get an export improvement, then I think we can have moderate strength in the rupee. So the basic point is that the rupee is not going to strengthen against everybody. Never. That'll never happen. Okay. It does not, the rupee's nominal effective exchange rate has to be broadly stable with a slightly bias towards a slight depreciation, about 1% a year.
Okay.
So that, I think, that policy is not going to change anytime soon, because we are still a current account deficit country. And as a current account deficit country, we cannot afford to have trade-weighted appreciation of the rupee in nominal terms. So we'll have moderate depreciation against the basket,
okay,
but probably a period of slight strength against the dollar over the next 6 months.
Mm-hmm. So one of our viewers has sent a question on YouTube. I'll just take that question. It's Mr. Narendran, and his question is, how metal sector will perform in 2023, sir?
Okay, that's an interesting question. The view is that metal prices, particularly copper, iron ore, etc., will go up a lot. That's the consensus view. They'll go up given that China is reopening. China's reopening will result in China sucking in demand and boosting metal prices a lot. I don't think so. My view is that metal prices will rise only very moderately this year, because China as a source of strong demand is going to be absent. So we, at the beginning of the year, we've got a general sense of optimism related to China. Partly that is simply a fact, simply because China was one of the worst performing equity markets in the world last year. And almost everybody was heavily underweight. Most investors were heavily underweight China. Mm-hmm. Now they've gone from being heavily underweight to only moderately underweight. So if you go from having, you see, in the emerging markets index, China's weight is extremely high. We have a 30% weight in the benchmark for China, and everybody's underweight. They could be underweight to the, if they have, say, 18% in China, that is very underweight relative to the benchmark. If they've gone from 18% to, say, 23%, that itself is going to lift China market. So that's essentially what's happened in the first 2 weeks of 2023 calendar year. There's been a revival in the weights for China, and that has resulted in the China equity market doing rather well. And if China equity market is doing well, the sudden optimism emerges. People start thinking, oh, the Chinese economy is about to take off. I better not be absent. So maybe, metals also will do very well if China's economy is going to grow strongly. So I don't think that the Chinese economy is going to take off and go to the races this year. I would expect that real GDP will grow about 3.5 to 4% in China this year, helped by low base effects. There was a lot of, last year was a relatively weak year. There was some, fourth quarter was weak, uh, and second quarter was also very weak. So you've had 2 weak quarters. So you could get 3.5 to 4% growth. But from here on, China is never going to do much more than 3 to 4% annual growth, if it achieves even that.
Okay.
And so metals will not rise dramatically. So I don't expect that we'll see a dramatic increase in metal prices. But given that there's a global recovery in investment spending in the rest of the world, there should be mild uptick in metal prices this year.
Thank you, Mr. Basu, for being with us. I appreciate your time.
Okay. I didn't realize we were already running out of time. We could take one more question, maybe. We have 4 minutes.
Okay. So as you were talking about Japan, sir, you have inflation there now at 40-year high. And there are no indications as of now of tightening, but as you said, there might be some kind of a tightening happening anytime soon. So what implications will that have on the export market of Japan, and how will it impact positively the Indian markets?
Well, first of all, Japan, yes, you're right that Japan hasn't had this kind of inflation in a very long time. But the important thing for Japan is that this was their goal. They had not achieved this 2% inflation target. They weren't able to get there. Other countries had exceeded it by a lot. Japan hadn't been able to get it up. So now that they have succeeded, we've already, not in the latest BOJ meeting, but the previous one, the latest BOJ meeting turned out to be a damn squib. They did nothing. There were lots of expectations. Is Japan about to take it up to 1% now? But Japan said no. So we're getting to the end of Kuroda's term as BOJ governor. And he is, I think he's largely succeeded in his goal of getting inflation up above 2%. I don't expect Japan to aggressively tighten, but they will be in a position to do a little bit more. And the key for Japan is to generate some wage growth. They had forgotten about the meaning of annual increases in wages and in salaries. So all of that will slowly come back, and Japan will have a reflation trade. Now, the important thing for us is that Japan still is an important supplier of technology. It has some key technologies where it is still a global leader. Japan is looking to India as an important partner, very crucial partner. Japan is uncomfortable about the extent of its dependence on China. And so what we will hopefully try to do is to encourage Japanese capital to come to India on a much larger scale in areas like EVs, or Japan doesn't do electric vehicles much, but hybrids. If you can encourage the transfer of hybrid technologies to the likes of Maruti Suzuki and perhaps even to Tata and Mahindra, the other players in that space, then we can begin to have some advantages. Green hydrogen is obviously another area where India and Japan are looking to cooperate. Solar modules. So these are now Japan has done remarkably well in environmental achievements in cleaning up its economy. Japan was a very polluted economy in the 1970s. Today, if you go to Japan, the quality of air in Japan is remarkably clean. So Japan has a lot to teach the world and teach its partners. So India and Japan can collaborate in the environmental space in creating green technologies for the rest of the world. And Japan has a surplus of capital. India has a surplus of labor. There is potentially a meeting of minds there. But India also needs to sell its case. We can make the case that India is a place where you have a much more flexible labor market than has ever obtained in the past. And this is not a difficult argument to make in Japan, because Japanese investors, the investor community in Japan, as well as the industrialist community in Japan, are aware of the successes of Maruti. Suzuki, as they think of it. Suzuki has India as its largest market by a long way. It's much bigger than Japan. So, and Honda motorcycles had India as an important market. So if we can get all of those to collaborate more closely with India, then there can be a lot of mutual benefit, apart from the fact that India and Japan are strategic partners in the Quad. The Quad is aimed at being a strategic alliance, but also the other aspect of it is the way the strategic alliance can be mutually beneficial to all will be through economic cooperation. And I think those are the areas where capital and labor, Japanese capital and Indian labor collaborate. Japanese know-how in green technologies and environmentally cleaner technologies can be of great benefit to India. And and in areas like nuclear technology, if they can play a part in areas like the quality of television screens and all of that. There's a whole slew of industries in semiconductors as well. We can get a collaboration with Japan to get going.
Thank you so much, Mr. Basu, for being with us. It's always a pleasure to listen to you, sir.
Thank you so much, Gitu.